Welcome back to The Explainer. Today, we are diving into a seriously fascinating financial case study that completely strips away all the usual noise of the stock market. We're talking about a super strict framework here. Exactly $100, exactly 30 days, and absolutely zero cheat codes. Let's break down the psychology, the strategy, and the raw results of this 30-day micro-investing challenge.
$100, right? It is a very specific and honestly pretty humble starting point. But the mission of this case study was crystal clear: respect the microcapital. It's really a strict proof of concept to see if a small, defined chunk of money can be mobilized to create actual growth in just 1 month. Every single cent mattered here, which established this rigid parameter that completely eliminates the luxury of a massive bankroll safety net.
Okay, let's dive into this framework, because setting these hard boundaries is really where the true learning happens. The experiment relied on 3 unbending rules to keep the whole challenge honest. Rule number 1, you can only use one specific micro-investing app. No jumping around between complicated trading terminals. Rule number 2, no adding extra pocket money. What started the challenge was all there was. And rule number 3, absolute transparency. Every single win and loss had to be documented to truly dissect the process.
So day 1 hits, and the action was immediate. The very moment that initial capital cleared, it was split right down the middle in what's known as a classic barbell strategy. 50% was anchored in a nice, stable ETF, while the remaining 50% went straight into a high-risk, high-volatility pick. The logic here was simple but highly effective. Balance that stability with the potential for aggressive, outsized growth. Basically protect half and put the other half to work in the wild.
But as literally any experienced investor will tell you, things rarely move in a straight line. By day 5, the reality check of a market drawdown hit hard. And this is exactly where loss aversion triggers. That horrible psychological pain of losing money, which always feels twice as powerful as the pleasure of gaining it. It totally tests a trader's resolve. The days absolutely dragged on, but by holding ground and just waiting it out to day 10, the portfolio finally dragged itself back to break even.
Now this brings us to the exact mistake most beginners make in this scenario. They lock in their losses out of sheer fear. They just sell the moment they see red. Surviving that early dip proves what is arguably the simplest yet hardest financial rule to actually execute. Patience beats panic every single time. It's incredibly easy to say, but exceptionally difficult to practice when your real capital is on the line.
Then came day 14, and we needed a vital strategy shift. Look, surviving the early panic just wasn't enough. The portfolio needed a real mechanical method. So, relying on gut feelings was completely abandoned for a quantifiable metric, the 200-day moving average. Using this mathematical indicator dictates momentum by filtering out all that daily market noise. Instead of letting emotions drive the trades, it completely removes the guesswork and establishes a simple, repeatable rule.
And wow, did that strategic pivot change the entire trajectory of the challenge. By day 18, the momentum officially shifted. The balance finally tipped, and for the very first time since the initial deposit, the portfolio was genuinely in the green. Pushing into official profit provided tangible proof that the rule-based strategy was actually gaining traction. But rather than just passively riding that wave, immediate action was taken.
Now, here is the absolute game changer. The real aha moment of this explainer. The exact moment a solid profit materialized. That initial $100 of capital was taken completely off the table. This triggers what behavioral economists call the house money effect. By withdrawing the original capital, the portfolio is now operating strictly on market profits. It creates this beautiful zero-risk scenario that completely liberates your decision-making because, well, the absolute worst-case scenario is simply breaking even.
So, with the original risk literally completely eliminated, those last 12 days just flew by. Reaching day 30 was the ultimate test of this hands-off, disciplined process. The suspense was intense leading up to the final market close, just waiting to see exactly where the final trades had landed. No distractions, no outside capital injections, just the raw, unedited result of a 30-day rule-based system.
$147.50, a staggering 47.5% return in just 30 days. Now, while hitting a near 50% return in a single month is exceptional, it perfectly highlights the volatile upside of microinvesting when a high-risk barbell strategy actually hits its target. Seeing that final number provided undeniable proof that the constraints, the patience, and the rule-based pivots executed throughout the month absolutely worked.
But actually, scratch that. The true story here isn't the $47 profit. The money is great, for sure, but it isn't the biggest win. The real value is the framework itself. By operating within a rigid 30-day box, emotional reactions are systematically ironed out, a moving average rule is battle-tested, and a real method for securing initial capital is perfected. That repeatable system, that is worth infinitely more to an investor's long-term trajectory than a quick $47.
So what does this all mean for us? Breaking down the actionable takeaways from this case study reveals 3 really distinct steps. Number 1, you don't need thousands in liquidity to start. You just need a strict plan and unyielding discipline. Number 2, prioritize capital preservation. Pulling the initial risk off the table on day 18 is exactly how you survive long-term in finance. And number 3, consistency beats intensity. Systematically deploying $100 will consistently outperform randomly throwing $1,000 at the market once a year.
If you want to dive deeper and see the exact mathematical framework behind this case study, and honestly see how it handles those wild emotional swings of the market, the original tracking spreadsheet is linked right down in the description. It maps out every single day of the 30-day cycle. Plugging in your own numbers offers a really direct way to stress test your own discipline, because let's face it, having the right tools to track your metrics is literally half the battle.
The concept is definitely proven at $100, but it begs a much larger question. Does a mechanical, emotionless system like this hold up when you drastically scale up the capital? I mean, would an investor have the absolute nerve to faithfully follow the 200-day moving average if $50,000 were on the line instead of 50? That right there is the real psychological barrier. Let us know in the comments if we should scale this up to $500 next, and if we hit 100 likes, we will trigger the next level of the experiment tomorrow. Thank you so much for joining this explainer, and we will see you next time.